Hey everybody, what's up? We are back with another stock analysis. Today we'll be looking at Alibaba. So I think most people know what this company is. It's definitely one of the bigger ones I've reviewed, but they do online retail as well as a few other things like just like digital media, entertainment, commerce in general. So going over the basic statistics, market cap is at 191 billion, 1.2 dividend, not too bad. Target price is at 119. Long-term growth rate at 7.6%, which is pretty good. Significantly under the target price at the moment at $81 a share, so looks pretty solid there. If we look at their little chart here, we can see they topped out right around $300 and are trading right around the $70 to $90 range for the past couple of years, actually. So they had a pretty big fall off in 2020 and since then just haven't really recovered. So I'm going to assume that they are significantly undervalued at the moment just based on where they used to be. However, we will get into that shortly. Looking at their overall growth summary, we could see sales are expected to massively increase. Actually, across the board, long term, everything is expected to increase a lot. One major thing to note is just short-term net income and free cash flow are a little negative, but overall everything else is looking pretty good. So definitely very positive growth summary there. Let's get into some of their financials now, starting off with their income statement. So first off, this is in the quarterly view, but we can see fairly significant increases over the past 2 years or so. But let's zoom out into the fiscal years and see what we can see. So hopefully they have complete data for 2024, which they do not. They do actually. Sorry. They do have complete 2024 data, which is good. So a lot of growth between 23 and 24. However, still down from the high in 2022. But honestly, I don't think that's too big of a deal. I think they're still kind of coming out of where they were post COVID. And also, another thing to note is that the estimate for the finalize of 2024, which I'm assuming this just isn't completely finalized yet, the estimate for them is actually higher than they were in 2022. So that is something to look out for. Could be better, but we'll just have to see when everything is finalized. So next, looking at their operating income, and it looks like they actually did fairly well for 2024. Obviously, their margins are fairly low considering it's retail, but that's no big deal. It's kind of an industry thing. Net income looks pretty good. Obviously, they are significantly lower than they used to be. They actually have half the net income that they had in 2021, despite having almost 30 million more in sales. So, or sorry, I believe this is actually billions, which yes, it is. So they do have a significant decrease from where they used to be. So their margins used to be a lot higher. Now they're not. So that is probably the biggest thing with the company in terms of like a short to midterm problem is their profitability ratios. Another thing to look at is their total shares, which actually have been decreasing for the past 4 years now, which is a fairly good sign for the company. That's what you want to see. Other than that, let's hop over to the balance sheet now, see what we can see there. So cash looks solid. I'm assuming this is in billions. So they have $81 billion in cash for 2024, which is massive. One thing to note is that their overall assets, I believe, are decreasing over the past year, but their cash is fairly consistently increasing. So they have a lot of money that they can put towards things like new investments, new acquisitions. Also, very little debt, at least compared to how much cash they have. They do have 23 billion in long-term debt is a lot, and 5 billion in short-term debt is a lot. But compared to their cash, it's really nothing major. So overall, across the board, their balance sheet looks very, very healthy. A ton of cash, a ton of capital that they can use in the future. It's just a matter of when they will do that and how profitable or how much of an improvement it will bring with it. So definitely something to watch out for in the near future, just seeing what they do with all that cash they have. So next up on the list, we have their actual cash flows, and we could see operating cash flow is fairly steady. They are a little bit down from their high in 2021, and hopefully we can see them get back to that place soon because, again, we did state earlier, they do have much more sales than they did back then. So realistically, they should be approaching that number again soon. Um, but moving past that, investing cash flow looks good. A lot of it is going into purchasing investments, although in 2024 they didn't really do that as much. Also, capital stock, they have been repurchasing a lot over the past few years, which is another very positive metric to look at. And free cash flow just across the board is very positive, which is also very good. Um, does look like they're going through a little bit of a decrease, at least for the 2024 estimate, but that's really no big deal for the most part. Obviously, again, that 2021 high that we saw is kind of something that they're should try to be getting back to, but overall, it looks like that's probably a year or two away. We can see their overall earnings through all their segments here. So 2024 was all-time high sales again, but in terms of profitability, it wasn't. One thing to note is that their others segment, which I don't believe is new, which it is not, their other segment has grown to 18.9% of their revenue, and it's actually their second largest now, after previously in the past being one of their smallest. So definitely something there. I don't know what their other segment consists of, but I'm assuming it is something that they're heavily investing into. And just based on where that growth is, it's definitely doing well for them, to say the least. So moving on to their ratios, we kind of see the profitability ratios declining, which I talked about earlier. So we're at 35% for their gross margin. In 2021, they were at 39%. And actually, they used to be significantly higher, even before that, all the way up to 63% in 2016. So they are below the 5-year average for 2024. Same thing with operating margins, slightly below, and net margin is coming in 6% lower at 8.5%. And then we do see that very, very steep drop off after 2021. So overall, major thing with the company driving profitability. Now, don't get me wrong, for a retail company, a net margin of 8.5% is actually really solid. That's a fairly good number. But just compared to where they're used to be, it's not great. And the sales growth has not compensated for it yet. So they need to see a lot more sales growth to justify these numbers at the valuation they used to be at. But overall, I think if they can do that, we will see them return to their past valuations. But it's just a matter of how long will that take at this point. Another thing is the ROA, ROE are both significantly below their 5-year averages. And scrolling down to the bottom here, long-term debt ratio, like we said earlier, is nothing crazy. 17% is very, very manageable. One thing I will say is I actually think this should be higher because, like I was saying, with their sales not being where they should be based on where their profitability numbers are, they need to be taking out more debt. And even though realistically they don't, they just have too much cash. There's too much cash in this company. $80 billion in cash, which we looked at earlier, is way too much to have. And 83 billion actually, that is way too much when your profitability is decreasing. That needs to be reinvested in the company, because so far with their massive cash pile over the past 4 years, their stock price has nothing to show for it. So there's a lot of potential with that enormous amount of cash, but they haven't done anything with it yet, from what I could see. And at the very least, if they are doing things, it hasn't reflected very much in the stock price because their valuation is still significantly lower than where it used to be. So now let's get into their last earnings report. We should have a couple metrics here. And actually, we have a lot of metrics here. So let's get into this. This is all in Chinese currency, just to be aware, but the increases are still relevant. So overall, core commerce decreased very, very slightly. You can read through the specifics of each segment if you want. I'm not going to do that, but cloud intelligence looks like slight increase. Digital media and entertainment had a decrease of just under $1 billion. Other surpassed greatly, which we talked about earlier. Their other segment is a huge part of their revenue now, and beat estimates by over $4 billion, which is huge. And then consolidation adjustments was actually $3 billion more in the negative than they were expecting. Gross margin beat estimates. EBITDA margin beat estimates. The overall EBITDA beat by just a couple million. And this is just the EBITDA for all their segments then, if you want to look through that. And other than that, there's not too much else to go into. Let's see if we can get some actual words being told here about the company. So I'm not going to read through everything. If you'd like to pause and read through everything, you can. But overall, I'm just going to focus on this part right here. So continue to invest in user experience and strengthen product offerings. Enter into long-term collaborations with industry peers to broaden logistics services, Taobao and Tmall platforms, which is good. They're focusing on high growth opportunities, accelerate our overall growth, which we were talking about earlier. That's what they need to do. Growth in their cloud business accelerated, which is good. Revenues growing in double digits for their cloud services. More confident in our core businesses than ever, and will continue to invest in supporting long-term growth. So overall, that sounds very positive. And obviously, with the metrics we saw earlier with the sales growth and the slight beats on their margins, it's looking like they are moving in that direction. But overall, the valuation just is not there yet. Now, their last earnings report, they're actually down from that, despite what I just read through. Everything seems very positive, but they are still down from there. So I'm assuming investors just didn't see what they wanted to see. But I think if they could get sales, or I should say profitability, back to where it was, or at least closer to where it was, or have their sales grow to the point where their current margins surpass what their former profitability was a few years ago, I think we can see them return to where their stock price used to be. Now, I'm not saying it'll go up 200-300% in 1 year, but long term, 3-4 years out, I think we can see that happening. But overall, it's just about returning to profitability, which they are profitable, just not close to where they used to be. So that's all I have for Alibaba. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see everybody in the next video. Thanks for watching.